baskets. Okay. In our last class, we started discussion around the cost of capital. Let me just do a kind of a recap to what we did in our first day lecture on my scope on strategic financial management. The first topic we started, which is still what we have, is cost of capital, because cost of capital is foundational to almost whatever you want to do in strategic financial management. It's very key, very, very important. If you have in-depth knowledge of cost of capital, you're as good as understanding strategic financial management, because it links with almost all the topics. All right. So let's pick it. Let me just do a kind of recap for like 5 minutes. Then thereafter, we continue from where we stopped last time. We started with the introduction to cost of capital. And we said that cost of capital represents the compensation required by the providers of capital from their investments in a firm. For example, the equity holders, that is the shareholders, they have provided capital to finance the operation of the business with the hope of earning a return on their investments. The same thing with preference shareholders. They have invested in the business with the hope of earning a return on their investment in form of a fixed dividend, right? The debt holders also, the lenders, they also invested in the business with the hope that the company is going to pay them return on their investment in form of interest, all right? So the cost that the company will pay for the capital contributed to finance its operation is what is known as cost of capital. And we said that it is determined majorly by the market forces of demand and supply, depending on the perceived risk associated with the business. That is not the only determinant of cost of capital. I just chip in just to buttress the point. As we proceed, I'll be telling you more. However, when we left the introduction, we also dissected the importance of cost of capital. We said that cost of capital is important in strategic financial management. And the significance of cost of capital, examiner can ask you to explain the significance or usefulness or importance of cost of capital. All right, it could be any one of those three, but you have to know what you are doing, particularly at this level. And that's why I was advising you last week that please don't cram. Cramming can only help you for the short term. You need to understand the concepts. You understand the underlying concepts so that you will be able to express yourself freely, particularly at this level. You know, I told you last week, examiner is not asking you to go and write to provide a voluminous solution. Just demonstrate that you understand the requirement. That's all. Not that you write about 10, 15 pages. Your answer booklet is full. You're asking for extra. You're asking for extra. You know, nobody is asking for all of that. Just show me, demonstrate that you understand the requirement. That's all. Make sense in your solution. Okay? So we said the first importance or significance or usefulness of cost of capital is project evaluation, that is investment appraisal. In the determination of financial viability of a project, when a company wants to evaluate a project, okay, cost of capital will be required to discount the future expected cash flows to the present value equivalent using relevant investment appraisal technique. So without the cost of capital, it will be almost impossible to appraise a project. That is one of the usefulness of cost of capital. Number two that we spoke about is determining debt equity proportion. That is, cost of capital will enable a company to determine or to ascertain the proportion of equity and debt, or that is the mix of capital to be carried in the capital structure in order to minimize the overall cost of capital for the firm. So that's another importance of cost of capital. It's not just those two, there are other ones. For example, performance evaluation. Cost of capital is used for performance evaluation in order to measure whether a company has been able to create value. A company will be able to create value if the return on capital employed, all right, is greater than the cost of capital. So it is that cost of capital you are going to use to benchmark the return that the company or the project is going to generate in order to create value. You know, I mentioned last week when we started this, that a company must generate sufficient return over and above its cost of capital. So the return on capital employed must be greater than cost of capital. So if the company is able to achieve, if the ROS, that is return on capital employed, is greater than the cost of capital, it means that the company has been able to create value. You can use that to measure performance. Okay, you can use it to measure performance. That's one of the significance of cost of capital or usefulness of cost of capital. Another one is for valuation, right? We use cost of capital to discount the free cash flow, okay? In order to enable a company to know whether they are going to create synergy, or they are going to create additional synergy for the business, or to maybe they will be able to create value, because the essence of valuation is for you to know whether you should go ahead and acquire or merge with another business. You only go ahead if it will enable the company if it will increase the value of the business. If the value of the business increases, it means that the shareholders' equity value will also increase. So you also use cost of capital for the purpose of valuation. So these are some of the key importance of cost of capital. We then move on to discussing categories of cost of capital. And we said that cost of capital can be grouped or categorized into three. And that anytime you are asked to calculate cost of capital, it has to be one of the three. The first one is traditional weighted average cost of capital. Number two, project-specific cost of capital. And then number three, weighted average cost of capital of the combined activities. These are the three cost of capital. We started with traditional weighted average cost of capital. And we said that traditional WACC can be computed or should be computed when information about capital structure, when you are given ordinary share capital, preference share capital, and debt capital, including their underlying costs. In the question, you are also given dividend information, you are given interest, and you're asked to calculate cost of capital. In that case, the appropriate cost of capital should be traditional WACC. And we said that to calculate traditional WACC, there are 4 procedures we are expected to carry out. The first step is to calculate cost of equity. Step 2, you compute cost of preference share. Step 3, you determine cost of debt. And then step 4, you estimate weighted average cost of capital. These are the 4 procedures you are expected to carry out anytime you want to estimate traditional weighted average cost of capital. We then started with the first step. We started with cost of equity. And we said that cost of equity represents the minimum required rate of return expected by the ordinary shareholders from their investment in a firm. Okay? Then we then talk about the methods of calculating cost of equity. We said cost of equity can be estimated using, number 1, dividend valuation model. You can call it dividend valuation model or dividend growth model. Method 2, capital asset pricing model. And then method 3, Miller and Modigliani formula. We started with dividend valuation model. We said that dividend valuation model should be used to calculate cost of equity when information about dividend and share price are given. And for that purpose, cost of equity will be computed as the ratio of dividend to ex-div share price, depending on whether or not there is growth in dividend payments. Okay. And I provided you with 2 different formulas that you can use to estimate cost of equity using the dividend valuation model. Then we then discuss the concepts of cum-div and ex-div share price. Okay, and we said cum-div share price is the share price that includes dividend. That is, when you are told in a question that dividend is outstanding, or dividend is about to be paid, or dividend will be paid, it means that the share price given in the question is cum-div share price. And in the calculation of cost of equity, you don't use cum-div share price. It has to be ex-div share price. Hence, what is ex-div share price? We said ex-div share price is the share price that excludes dividend, and it is the share price that should be used to calculate cost of equity. We now said if cum-div share price is given to you, it should be converted to ex-div share price by deducting the current dividend from the cum-div share price. Finally, in our discussion last week, we then moved to discussing or to dissect how to estimate growth rates. We said that there are 2 methods of calculating growth rates. Number 1 is historical pattern of dividend payments. And then number 2, Gordon growth model. And we said the historical pattern of dividend payments should be used to calculate growth rates when the history or past information about dividend payments are given. So when you are given the amount of dividend paid for the relevant years, then it means that you are supposed to calculate growth rates using the historical pattern of dividend payment, also known as averaging method. Again, I provided you with 2 different formulas depending on the information available. I also demonstrated that with examples, what you need to look out for in a question to know which of the formula to calculate the growth rate. Then lastly, we discussed the Gordon growth model. And we said Gordon growth model should be used to calculate growth rates when information about earnings, that is profit after tax, and capital employed are provided. Okay? And I said that capital employed can be defined in several ways, including total assets. Let me put it, I'm not sure I wrote it down. Let me just Okay, this is where we, like I said, this is where we stopped last time. So let me just, as an addition to this information, all right? So notes, all right? Um, capital employed can be defined in several ways, including, in fact, that's one of the limitations of capital employed, all right? So including total assets, capital employed can be total assets, okay? Let me just, instead of creating, let me just do it this way, including total assets, all right? Net assets, you have done financial statement analysis, okay? And of course, Mr. Ashwaju, we still do financial statement analysis with you, this diet. So under the financial statement analysis for ratio analysis, for example, in the primary ratio, for the primary ratio, that's where you calculate return on capital employed. So it's one of the limitations of return on capital employed is the definition of ROS, because it can be defined in several ways, just like I'm saying here. All right. So there's no specific way you can it can come in any form depending on the information available. So net assets, it can also be debts. It could be debt plus equity. All right, it could be debt plus equity. It could even be opening shareholders fund. All right, opening shareholders fund. All right, so that's that. Just as an addition to, since I did not write it down. Okay, let me do this like this. I don't want to have so much gap. Amabino, where are you? Just come here. Get out. Don't waste my time. It's better now. Okay, so this is where we stopped in our last class. I also demonstrated how you can calculate the growth rate using the Gordon growth model. So today we are going to be discussing cost of preference share. Cost of preference share. Yeah. Move. I don't want to. Let me start from another page. Okay. Yeah. So we are going to be starting with cost of preference share. Please open to the material at your end so that you can follow through together. This is what I'll be using so that I can easily express myself. All right. So let's talk about cost of preference share. So what do you understand by cost of preference share? The cost of preference share represents the compensation required by the providers of preference share capital from their investments in a company. The preference shareholders are entitled to fixed dividend from the business, and they must be paid before the ordinary shareholders. Yetunde, yes, what's your question?
Okay, good evening, sir. I remembered you gave us 3 different methods to calculate cost of equity. We only did dividend valuation. I just want to clarify if we're doing the other parts too.
Yes, I
That's
mentioned
the
it.
CAPEM and Miller and Modigliani.
I mentioned it. The capping, we are going to, when you look at my scope that I mentioned to you last time, I told you that we are going to do portfolio and the capital as a pricing model. So it's a topic we are going to discuss. Immediately after cost of capital, we are going to discuss that. And I also mentioned that the Millian and Modigliani, we are going to use it. It's just a formula. So we are going to use it when we get to adjusted present value. All right?
All right, noted, sir.
All right then. So, like I said, cost of preference share represent the compensation required by the providers of preference share capital from their investments in a firm. The preference shareholders are entitled to fixed dividend from the business, and they must be paid before the ordinary dividend is paid. Okay? Generally, preference share can be cumulative or non-cumulative, redeemable or irredeemable, participating or non-participating. In all of this, our focus will be on the redeemable and then irredeemable because that's where you have calculation. Other ones, they are purely for your information. All right. For example, when you talk about cumulative preference share, what that simply means is that, preference dividend is paid from the profit after tax, right? So in any year a company uh, make a loss, the company will not be able to pay any dividend because that would be double jeopardy. Therefore, the preference dividend the company is supposed to pay in that particular year will not be paid because the company make loss. Therefore, this preference dividend will be carried forward until the company is able to make sufficient profits to pay the outstanding dividend and also the current one. So it means that the preference dividend the company is supposed to pay in the first year will be carried forward to the second year. Even if the second year the company also make a loss, you are going to add it to this. You add the dividend of the first year to the one you are supposed to pay in the second year. If in the third year the company is able to make profits, then all the outstanding dividend must first of all be deducted from the profits. If there's any residue, then you can be talking about paying ordinary dividend. So this is cumulative preference share. Non-cumulative simply means that if the preference dividend, if the company is unable to pay preference dividend in a particular year, the preference shareholder will forfeit the dividend. They are going to forfeit the preference dividend. You can't carry it forward. That is non-cumulative. Okay. So like I said, the focus of our class will be on redeemable and then irredeemable because that's where you have calculation. So let me just jot some things so that my screen will not be empty. So like I said, cost of preference share represents the compensation required by the providers of preference share capital from their investments in a firm. Okay. The preference shareholders are entitled to fixed dividend dividend from the business. Okay. And they must be paid. It's network. Let me reshare.
Welcome back, sir.
Okay. Before ordinary dividend is paid. Okay. Let me see. What's wrong with you? Give me what I want. That. I always like my things to be in order. That's why. It's not my fault. Okay. And I also said preference share generally preference share can be cumulative or non-cumulative, participating or non-participating. All right. Redeemable or irredeemable. All right. So our focus will be on redeemable as well as irredeemable. So let's start with irredeemable preference share. Okay. Irredeemable preference shares. So what do you understand by irredeemable preference shares? The irredeemable preference share is the one in which the company is expected to pay annual fixed dividend, but the principal will not be repaid. I repeat, the irredeemable preference share is the one in which the company will pay annual fixed dividend, but the principal will not be repaid. Let's say, for example, a company invested 1 million naira in another company in preference share, right? With the hope of earning 10% return on its investments. So 10% of 1 million naira is 100,000. So if it is irredeemable preference share, so let's say, of course, the company will continue to pay annual fixed dividend of 100,000 naira to perpetuity. As long as the company is still in operation, they will continue to pay the preference dividend of 100,000, that is 10% of 1 million naira for the foreseeable future. But the principal that the investors has contributed in the business, that principal of 1 million naira that the investors have contributed in the business, they will never get it back. All right? They won't get it back. That is irredeemable preference share. So the cost of irredeemable preference share represents the ratio of fixed dividend to ex-dividend share price. I repeat, The cost of irredeemable preference share represents the ratio of fixed dividend to ex-dividend share price. Okay, so before I show you the formula, let me put down some, let me just summarize the notes. All right. This is the one in which the company is expected to pay annual fixed dividend. Okay, but the principal will not be repaid. So the company will not pay back the principal contributed by the preference shareholders. What's wrong with you? In which, okay. So the cost of, I also said the cost of irredeemable preference share is calculated as the ratio of fixed dividend to ex-dividend share price. The formula below can be used to estimate the cost of irredeemable preference share. All right. So what is the formula? What is the formula to calculate cost of irredeemable preference share, which is denoted as KP? You already have the formula in your material, so let me just start 1 minute. Let me bring out my, let me start with, okay, let me just use this one. All right, so to do this, you go to the question and pick fixed dividend for the preference share, dividend, then divided by ex-dividend share price. The concept we discussed last time in relation to cum div and ex-div share price, they also applies to preference shares. So note that, because if the preference dividend has not been paid, it means that it is cum int price, sorry, cum div price. So you have to convert it to ex-div share price. Okay, so this is the formula for calculating our cost of irredeemable preference share. Then let's move to, this is all about irredeemable preference share. Okay, then let's move to the second one, which is redeemable preference share. So what do you understand by redeemable preference share? This is the one in which the company is expected to pay annual fixed dividend, and the principal at the maturity dates. When you talk about redeemable preference shares, the company will pay to the preference shareholders annual fixed dividend, and at the redemption date or maturity date, the company will also pay the capital contributed by the preference shareholders. The company will return it to the owners. That is redeemable preference share. The cost of redeemable preference share is calculated as internal rate of return. Okay, the cost of redeemable preference share is calculated as internal rate of return by carrying out specifically two steps. Step 1 is to assume two discount rates that will produce two opposing NPV. Then step 2, we calculate cost of redeemable preference share using internal rate of return formula. It's as simple as that. No matter how big is the question, if you want to calculate cost of preference share, first thing first, you need to identify from the question, what's the nature of the preference share? Is it redeemable or irredeemable? The fact that examiner has called it redeemable preference share does not make it irredeemable. All right? So there are specific things you should look out for in a question for you to be able to ascertain whether it is redeemable or irredeemable. So I will show you subsequently in a few minutes. All right, so let me just put something down under this so that you can go, we can cover as much as possible today. All right, so I said this is the one, redeemable preference share is the one in which the company will pay annual fixed dividend and the principal. The company will pay annual fixed dividends and the principal at the maturity dates. Okay, at the maturity or redemption dates. The cost of, before that, let me put it this way. Redeemable or preference share can be redeemable. I'm sorry, can be redeemed. Preference share can be redeemed at par, premium, or discount. Okay. The par value, the nominal value or par value of preference share is always quoted at ₦1 per share. It's always quoted at ₦1 per share. So anytime you want to calculate cost of preference share, of course, when you talk about par value, what we simply mean is that it's the face value. All right, that's the nominal value. You can call it par value, face value, or nominal value, right? So if par value is ₦1, if par value of preference share is quoted at ₦1, it means that the premium, if preference share is quoted at a premium, it will be more than the ₦1. If it's at a discount, it will be less than ₦1. So you have to watch out for that. Okay. So I also said the cost. The cost of redeemable preference share The cost of redeeming preference share is calculated as internal rate of return by following or by carrying out the procedure, the steps below. All right. Anytime you want to calculate cost of redeemable preference share, the first thing you are going to do is to assume two discount rates that will produce two opposing net present values. That is a positive and negative NPV. Okay, so you have done this before. You have calculated NPV before. You have calculated internal rate of return before, so you will understand this. So that's the first thing you are going to do. Anytime you are asked to calculate cost of redeemable preference share, first thing first, you assume two discount rates. Examiner will not give it to you. You are the one that will assume it. All right? Because cost of redeemable preference share is calculated as internal rate of return. It's not more than that. So you assume two discount rates. One discount rate will give you a positive NPV. Then if, for example, you assume 10% and 10% produces a positive NPV, you need to increase to 15% to get a negative NPV. So once you have calculated a positive and negative NPV, you then move to step 2, which is to calculate internal rate of return. Okay? Calculate internal rate of return, or let me put it this way, calculate cost of redeemable preference share. Calculate cost of redeemable preference shares using internal rate of return formula. Using IRR formula as given below. Okay, so that's all you need to do. How do you calculate the IRR or cost of redeemable preference share? That is IRR. Okay, so how do you calculate internal rate of return? Let me just remind you, you've done this before. To do this, let me go to my formula bar. Insert equation. So like I mentioned to you last week, I'm also teaching you in case you want to use Word document to write. Maybe you are developing your book. These are some of the techniques, especially those calculation subjects. So this is one of the ways you can do that. So I'm teaching you, it's not just, I'm not only teaching you SFM, so I'm also teaching you the techniques of using a Word document to write. Okay then. So to get the internal rate of return, of course, we start with the lower discount rates. Lower discount rates plus the net present value. All right. Net present value of the lower discount rates. Okay. All over net present value of the higher discount rate. All right. Minus, sorry, let me use plus instead. Plus net present value of the higher discount rate. I can also change this one. Let me change this one to something else. Let me use this. Okay. So it will make more sense. This is all these are the challenges I go through when you are seeing Golden Book. Golden Book is not is a lot of effort that went into producing it. Sorry, this is A. Yeah. Just copy this, then you paste. Emma Bino, had it been I'm using the pen, this would have been Okay. Yeah, so it makes more sense now. Let me remove this. That's it. That's it. Then, of course, all of this multiplied by higher discount rates. Okay, higher discount rates. Okay. Minus lower discount rates. That's it. Of course, this one, take it outside. This is A plus. All right, so this is the formula. You're already familiar with this formula. So that's it. This is how to calculate internal rate of return, where, let me go to the next page. Where A is equal to lower discount rates. You already know this. This is just a reminder. B equal to higher discount rates. Okay, so that's that. Anytime you're asked to calculate cost of redeemable preference share, this is what you need to do. Just assume to discount rate that will produce to opposing NPV, and then step 2, you calculate the cost of redeemable preference share using the internal rate of return formula. Now, note, preference share will be redeemable. What's wrong with you? Preference share will be redeemable only if the redemption date, or maturity date is given. If the maturity date is not provided, it should be calculated. It should be calculated as cost of irredeemable preference shares. All right, so that's what you need to do. Given. That's all you need to do. So if in a question, examiner has given you information to calculate cost of capital, and in the question you can see preference share, and then the first thing you need to do is to ascertain whether it is a redeemable preference share or irredeemable preference share. The fact that examiner has called it a redeemable preference share does not make it a redeemable. What differentiates, what makes it a redeemable is if the redemption date is given in the question. Only when the redemption date is given is when you can calculate cost of redeemable preference share. If in the question, for example, examiner calls it redeemable preference share, but you are not given the maturity date, you are not given the redemption date, that means you are going to calculate it as cost of irredeemable preference share. All right. So please note that what differentiates redeemable from irredeemable is if you are given the redemption date. Faith, you are disrupting my class. Be careful. So what differentiates redeemable from irredeemable is if you are given the redemption date. Other than that, it should be treated as cost of irredeemable preference share. So this is all you need to know about how to estimate cost of preference share. It's no more than this. It's no more than this. So like I told you last week, our objective is to explain all the concepts, all right, from A to Z. Then we begin to solve different scenario questions, all right, so that you'll be able to, then when we are solving the question, we then refer to the treatment, the concept of each of them, all right. So that is that. That will also enable those that will be joining us subsequently to not to miss entirely, okay? All right then. So the next we want to discuss is how to estimate cost of debt. However, let me just do a recap on what we have done so far. We started with the definition of cost of preference share. We said that cost of preference share is the compensation required by the providers of preference share capital from their investments in a firm, and it is the preference shareholders are entitled to fixed dividend, and they must be paid before the ordinary dividend is paid. We said preference share can be cumulative, non-cumulative, participating, non-participating, redeemable or irredeemable. All right. We said irredeemable preference share is the one in which the company is expected to pay annual fixed dividend, but the principal will not be repaid. And the cost of irredeemable preference share is simply the ratio of fixed dividend to XD share price. So what that simply means is that if preference dividend has not been paid, it means that the share price given to you is cum-div share price. Therefore, you have to convert it to ex-div share price, the same way you normally do under the cost of equity. Then we move on to discussing the irredeemable, to discuss the redeemable preference share. We say redeemable preference share is the one the company is expected to pay annual fixed dividend and also the principal at the maturity date. So every year the company will be paying annual fixed dividend. Then at the redemption date, at the maturity date, let's say for example, the company has preference share capital of 1 million naira and that will mature in the next 5 years. So the next 5 years is the redemption date, is the maturity date. Therefore, every year the company is expected to pay annual fixed dividend, year 1 to year 5. Then at the final year, which is the fifth year, the company will pay back the preference dividend, pay back the capital contributed by the preference shareholders. That is redeemable preference share. And we said that preference share can be redeemed at par, premium, or at a discount. And then the par value of preference share is always quoted at 1 naira per share. All right. And not only that, we also said that the cost of redeemable preference share is computed as internal rate of return by assuming two discount rates that will produce two opposing NPV. And then step 2, you calculate the cost of redeemable preference share using the internal rate of return formula. And I also mentioned that preference share will be redeemable only if the redemption date is given. So if you are not given the redemption date, you are going to treat it as cost of irredeemable preference share. So this is all you need to know as far as preference share is concerned. So the next thing we are going to discuss now will then be cost of debt. Let's discuss cost of debt. Somebody sent a chat the other time. Let me check. Please always raise your hand and ask question if anything is not clear to you. All right, Olaide. Okay, so let's move on. Cost of debt denoted as KD. That's what I like this new syllabus. All right, because the examiner, the institute has exposed students to fundamentals of financial management. So you cannot, no student should fail strategic financial management if you have good understanding of financial management, because all the topics all the topics you have currently in financial management were initially under the strategic financial management. All right. So all what you have done in the financial management, you are still going to do them in under strategic financial management, which is what we are currently doing. All of this, if you did financial management last diet or previously, you see that it's the same thing. But what differentiates professional students to skills level students is your ability to bring to bear your professional judgment, your ability to incorporate ethical issues in the way you present your solution to the examiner. So that's, of course, the kind of question you meet at this level will be different from what you have at professional level. Sorry, at the skills level. And that's why it is essential for you to have deep understanding of the concepts. Don't cram, because if you cram, once you miss a step, that's the end of it. You can't move forward. You cannot express yourself the way you want if you cram it, because you want to be, you want to do it the way you have seen it in a textbook. You want to do it the way you have read it anywhere. But if you have the understanding of the concept on your own, you can write it down in your own language. When you learn something new, when you read a concept and you're able to write it down, you close your book, you're able to write it down on your own, and you are saying the right thing. Certainly, that means you've understand it. That's the way it works. That's the way it works. Okay, then. So, what do you understand by cost of debt? Remember how we started last week? We said there are 4 procedures of calculating WACC, of calculating traditional WACC. We have done the first one, which is to calculate cost of equity. The second step is to calculate cost of preference share, which we just completed. Then we are moving to step 3, which is to calculate cost of debt. Therefore, what is cost of debt? The cost of debt is the cost a company will pay on the debt capital. The cost a company will pay on the debt capital is represent the compensation required by the providers of debt capital from their investments in a firm. All right. The debt holders are expected or are entitled to earn fixed interest from from the business. All right. And in the event of liquidation, the debt holders will be settled before the ordinary shareholders and before preference shareholders and then ordinary shareholders. All right. Debt usually is a cheaper source of financing because of tax deductibility benefits. When there's a tax, certainly the company will benefit from that by paying a lower cost. All right. So that's why usually we say that debt is a cheaper source of financing because of tax deductibility benefits. Anywhere in a question, once you are given a tax, you should know that we are going to account for, or you adjust for tax. Okay. Also, Debt can be redeemable or irredeemable, callable or non-callable. All of these, the callable and non-callable, are purely theoretical. It has nothing to do with calculation, even though it's similar to redeemable and irredeemable. But I will just give you a kind of insight so that you know what is callable, what is non-callable. But for now, let me just put down a short note. So we said that cost of debt, this represents, okay, the compensation required by the supplier, you can call it supplier or provider, by the supplier of debt capital, okay, from their investments in a firm. It is the cost. It is the cost a company pay. It is the cost a company pays. A company pays for the capital, for the debt capital, okay, for the debt capital contributed in the business. It's a capital contribution as well. Contributed in the business, okay. The debt holders are entitled to fixed interest from the business or from the company. In the event of liquidation, when a company liquidates, in the event of liquidation, the debt holders will be paid before the preference shareholders and ordinary shareholders. Okay. All right. Debts usually or generally, debts is a cheaper source of financing because of tax deductibility benefits. So like I said, the company will enjoy tax shield when you finance with debt capital. You pay a lower cost. Okay. Debt can be redeemable or irredeemable. Irredeemable. Callable or non-callable. Okay. So that's where we stop. Now, before I give you the meaning of irredeemable, right? Let me just, like I mentioned, irredeemable. So, like I mentioned, when it comes to callable and non-callable, they are just for your information. They are just for your information. It has nothing to do. We don't have any, there is no calculation as far as callable and non-callable is. But let me just give you some kind of insights or understanding as per callable and non-callable. Usually, um, the price of a debt capital is usually driven by changes in interest rates. Okay, it's driven by changes in interest rate. There's a correlation between interest rates and the price and the market price of debt. For example, bond. All right. So there's what we call debt indenture. Okay, that's what we call debt indenture. Debt indenture is just like contract agreements. The company, which is the issuer of the debt, and also the holder of the debt, which is the bond holders, the investor or the lenders. All right. So there will be a kind of contract agreement between the two, which we call debt indenture. So the debt indenture will dictate the responsibility of both parties expressly. All right. So the futures of the debt, let's say for example it is bond, the future of the bond, like the issuer, the nominal value, the coupon payments, the coupon rates, the maturity, all of that will be included. All right. And also the debt covenants. Okay, so many things will be there in the debt indenture, but my focus is on the callable, right? So when you talk about callable debt, it simply means that the issuer of the debt, let me restrict debt to bonds. Okay, so the issuer of the bond can can call back, the usual of the debt can call back the bond before the maturity date. Let's say, for example, maturity date is in 5 years' time. Okay, and then the CBN, Central Bank of Nigeria, or the Apex Bank make changes to MPR, monetary policy rates. So if the interest rate reduces relative to what was agreed ab initio in the debt indenture, the issuer of the bond, that is the company in this case, will call back the bond, that okay, they have to reschedule it, they have to redesign it consistent with the new changes in interest rates. So this will allow the issuers to minimize its risk. All right. So it will allow the issuer to profit from that change in interest rates. That is what is called callable debt. All right. So it allows callable debt allows issuers to recall or to call back the debt before the maturity date. So like I was saying the other time, if for example in year 3 the interest rate reduces, that is lower than what was initially agreed in the debt indenture or in the prospectus. So this will allow the issuer to call back the debt. That is callable debt. All right. So you redeem the debt before the maturity date. That is callable. So non-callable is just the opposite of it. So irrespective of what happened on interest rates, you cannot call it back. You have to wait until the maturity date before the principal will be redeemed. All right. So that is different between the callable and non-callable. Of course, there will be a kind of a debt covenant in the debt indenture to protect the bondholder, because you can't just wake up because interest rate changes. We have 5 years. This debt has 5 years maturity, and then in the second year, because interest rate changes, then you now want to adjust the interest rate to reflect the new changes. I will not accept that. So the debt indenture, which is the agreement in this case, will expressly state the number of years that you would have spent before you can make any change. So you can't just call at a short notice to say, okay, let's change it because it favors you. It doesn't work like that. So as a bondholder, I also need to protect my own risk. All right. I have to protect my own interest, and then so that I want to minimize my risk exposure. All right. So these are the things you will do as far as callable and then non-callable debt is concerned. So like I mentioned, our focus is on redeemable and then irredeemable. Okay. So what do you understand by redeemable? This is redeemable. I wrote irredeemable. Okay, let me rewrite it. Oh, sorry, we're just starting. That means I was correct. Don't mind me. Okay. Irredeemable. Okay then. So what do you understand by irredeemable debts? The irredeemable debt is the one in which the company is expected to pay annual fixed interest, but the principal will not be repaid. All right. And the cost of irredeemable debt is calculated as the ratio of fixed interest to X interest price, depending on whether or not there is tax. Okay, that is the cost of irredeemable debt. So let me just quickly put it down. This is the one in which the company is expected to pay annual fixed interest, but the principal amount will not be repaid. That is cost of irredeemable. So that is irredeemable debt. All right. So every year the company will be paying annual fixed interest to perpetuity for the foreseeable future, but the capital contributed will never be repaid by the company. All right. So the cost of irredeemable debt is calculated as the ratio of fixed interest to X interest price. Okay. As shown or using the formula below, depending on whether or not there is tax. So anytime one of the mistakes of students generally under cost of capital is they usually forget to adjust for tax. They usually forget to adjust for tax for the debt when calculating the cost of debt. All right. So you have to avoid that. As the ratio. Okay. Yes. Wickers, talk to me.
Okay, so I was wondering if for irredeemable debt, the issuer of the the issuer of the debt does not that's the capital is not the principal is not repaid. So how do they recoup? How does the issuer of the debt recoup their principal? I was just thinking. for
Yeah,
irredeemable, where only
is the
principal is
nature.
paid.
Yeah, it's the nature of the investment. So it's what it is. That's why throughout the world, irredeemable preferential, even irredeemable debt is not common, right? Because I can't be that foolish for me to put in my hard-earned money into an investment that I will not be able to get my money back. It's not really, in practice, it's not attractive. However, the the preference shareholder, for example, or debt holders of irredeemable, let me restrict it to irredeemable debt. So the holders of irredeemable debts, they are going to benefit. They also have benefits, Remember what I said. For example, if you invest 1 million naira irredeemable debt in the business and you are entitled to earn 10% return on your investment, so which means that every year the company will be paying you 100,000 naira, isn't it? 10%
Yes.
of 1 million. So that 1 million naira, you continue to earn it to the foreseeable future. If the
Okay.
business is continue in operation for the next 100 years, that means you are going to earn that 100,000 for the next 100 years. And then if you invest your 1 million naira today, if in the next 2 years the company collapse, that means all your investment is gone. So that's the risk. So it's both risk and reward is attached to it. So there is always a benefit, but it's not that attractive relative to the bond. All right. And that's why,
Okay.
yeah, so you can see that the debt holders will earn the interest for life until the business collapse, they will continue to earn their return. That's how it works. All right. Okay. So to get, of course, like I told you, when you are calculating cost of irredeemable debt, you have to watch out for tax. If in the question you are given tax rates, then you must adjust for tax. So we can calculate this where there is no tax. Which formula are you going to use if there is no tax? So let me say this is A. Okay, so where there is no tax, the formula to calculate cost of irredeemable debts is fixed interest divided by X interest price. Okay, divided by X interest price. So of course, everything multiplied by 100%. So you can also see here that we have X interest price. So what that means is that you must adjust for, if you are given a cum int price, you have to adjust for X interest price, because when you are calculating your cost of irredeemable debt, or when you are calculating your cost of debt, it has to be X interest price. At all time, it has to be X. The interest must have been paid before you calculate your cost of debt. That's the implication. Given a cum int price, you must convert it to X int price by deducting the interest from the cum int price before you then go ahead to calculate your cost of debt. Okay, then the second one, where, let me just copy this. Okay. Number B, where there is tax. Remember, I told you earlier on that the cost that the company will pay will be lower where there is tax, because the companies must enjoy tax benefits. So as a result, the formula to calculate cost of irredeemable debts will then be fixed in the ratio of fixed interest adjusting for tax, 1 minus T. Okay. Then all divided by S inch price multiplied by 100%. So this is the formula for calculating cost of irredeemable debt when there is tax. When there is tax. All right. So that's that. Yes, one of you raised hand the other time. Is that not Promise? I think. Promise, you raised hand.
Yes, sir. I didn't see when you copied the formula. I was seeing fixed dividend instead of interest. So after you changed it, that was okay.
Oh, okay. It's all right. Thank you. All right. So this is what you are going to do anytime you want to compute cost of irredeemable debt. Simply go ahead and calculate. Okay, just go ahead and calculate, determine the ratio of fixed interest to X interest price. That's all. It's not more than that. It's not more than that. Anytime you are asked to calculate appropriate cost of capital, these are the procedures you need to carry out. All right. So the next we are going to discuss will then be cost of redeemable debt. Okay, redeemable debt. Let's talk about redeemable. So redeemable debt is similar to redeemable preference share. I have to be fast from this moment on so that we can complete the concept up to cost of convertible. So we're still going to talk about market value of preference share, market value of debt. All right. So, but for now, let's move on. Now, what do you mean by redeemable debt? The redeemable debt is the one in which the company will pay annual fixed interest and then the principal at the maturity date. Debt also can be redeemed at par, premium, or at a discount. All right, and then the nominal value of debt is always quoted at 100 naira per unit, except examiner says otherwise. Except you are told otherwise, it has to be 100 naira. In most cases, examiner will be silent. In that case, you should know that it will be quoted at 100 naira. So the par value of debt is always quoted at 100 naira per unit. All right. So that is that. Then how do you calculate cost of redeemable debt? The cost of redeemable debt is also calculated as internal rate of return. It's not more than that. Okay, it's not more than that. Let me quickly jot down something. This is the one in which the company this is the one in which the company will pay annual fixed interest and the principal at the redemption date. Like I said, you can call it redemption or maturity at the redemption date. Debt can be redeemed at par, premium, or discount. Okay. The par value or nominal value of debt is always quoted at 100 naira per unit. At 100 naira per unit. Let me bold it for you. That's an important information. At 100 naira per unit. Okay, so if the debt is quoted at a premium, that means it will be more than 100 naira. At times in a question, examiner can tell you that the debt is quoted at 5% premium. So if you are told 5% premium, it means that 5% over 100 naira. So that will be 105 naira. Examiner can also tell you that the debt is quoted at 2% discount. It means that you are going to deduct 2% from 100%, which is 98%. That will be 98 naira. Okay, so you must know how to make relevant adjustments when the need arises. Okay, so that's that. So I also said the cost of irredeemable debt is computed as internal rate of return. It's computed as internal rate of return. The same way as shown under the cost of redeemable under the cost of irredeemable. No, it's cost of redeemable. I wanted to say. All right. So the same way as shown under the cost of redeemable preference share. So our discussion under preference share is still the same thing here. Just calculate internal rate of return. That's what I mean by that. You assume two discount rate that will produce two opposing NPV. And then, of course, step 2, you calculate the cost of redeemable debt. Oh, yeah, you calculate cost of redeemable debt using the IRR formula. That's all. That's it. As shown under the cost of redeemable preference share above. Okay. Now, this is important. Note, just like we did under the preference share, let me even copy it. That will be faster. The same thing you have here. Okay, so you have to, these are the little adjustments. Anytime you are calculating cost of capital, these are the little adjustments you have to make. Otherwise, you may not get it correctly. So, debt will be redeemable. Debt will be redeemable only if the redemption date or maturity date is given. If the maturity date is not provided, it should be calculated or it should be treated. It should be treated as cost of irredeemable debts. That's it. It's no more than this. Don't let the examiner, don't let the examiner create fear in your mind or in your heart when you're asked to calculate cost of debt instruments. All right, cost of debt instruments, and then you're like, okay, what is debt instruments? That's not, it's not more, when you talk about debt instruments, it's not more than bonds, debenture, loan notes. All right, those are debt instruments, because debt, bond, debenture, loan note, they are just a kind of IOU, right? They are a kind of acknowledgement of debt. You are the debt, I mean, the issuer is giving you the certificate to keep it until the maturity date when you are going to redeem your capital. All right. So it's just an acknowledgement of debt. You know, you are also going to do, Mr. Shiwaji will take you bond valuation and analysis. Okay. Usually there are futures of bonds. For example, bond is the most popular of all the debt instruments. It's the most popular, is the most sophisticated, unlike the debenture and then the loan notes. All right. So there are futures of the bond, right? One of the futures of bond is the issuer. Bond can be issued by private companies or private or public companies. Debt can be issued by national, subnational, subnational like state and local governments. Debt, I mean, a bond can also be issued by supranational organization like IMF, like World Bank, World Trade Organization. Those are some of the supranational organizations because they also they behave. Those kind of organizations behave like a country. They relate with almost all the countries in the world, depending where their members are. Okay, and that's why we call them supranational organization. Okay, all right. So these are the issuers. The person, the investor that will provide the loan or the lender that will provide the loan, they are the bond holder, they are the debt holder. It is the issuer. What we are doing in the class, what we are doing currently, we are looking at the perspective of a company versus the investors. Okay, we are looking at the perspective of the company versus the investors. We are not looking at a country or any other kind of issue. So the company, if for example a company wants to execute a project that worth 100 billion naira, and the required finance is not readily available, what the company will do is to approach investors or some consortium of banks that, okay, please, I need this, right? So it is the company, the company, it is the company that will then issue a certificate or a kind of a high hold to the bondholders to say, okay, I confirm that I owe you so much until so much date in the future. All right. So you are acknowledging that the company is acknowledging that you are owing the bondholder or the debt holders. All right. So that is how it works, even in practice. All right. So it's just a certificate. When you say bond is a certificate. The venture too, the loan note, they are all a kind of a certificate, a high OU certificate to confirm that, okay, you are owing me. All the details of the debt of the bond, for example, will be there in the certificate and also in the debt indenture. Okay, so this is how it works in practice. The venture is closely, the venture and loan notes is closely related to bond, but like I mentioned, bond is the most sophisticated, it's more structured. Bond is traded on the Nigeria Stock Exchange traded, unlike the debenture. The debenture is more like a medium-term source of finance, right? Like between 5 to 10 years. That's the debenture. Loan. Okay, let me just go ahead. Let me maximize the time that I have. All right. So that is that as per redeemable debt. That's that as per redeemable debt. The next thing we are going to discuss under this will then be types of debts. Let's talk about types of debts. So what are the types of debts? Basically, debts can be divided into two. We have traded debts, then we also have non-traded debts. Yes, Wilkos, talk to me.
Okay, I wanted to find out if you started recording as you came back.
Oh,
If
thank
you're
you.
recording.
I think it's recording. Let me check.
Yeah, it's still recording.
Yeah, it's still recording. Thank you for the observation. So basically, debts can be divided into one, traded debts. Number two, non-traded debts. So anytime you are referring to debts, it has to be one of the two. Therefore, what do you mean by traded debts? What is traded debt? The traded debts are fixed income securities that can be bought or sold in an organized financial market. They are debt instruments that are tradable in the market. That is basically what traded debt is. Examples include bonds, okay, debenture or loan notes. They are fixed income security because the interest that the company is going to pay on the debt is fixed, and that's why they are called fixed income securities. So anytime you are referring to traded debts, it can either be bonds, debenture, or loan note. All right. So let me put it down for you. These are fixed income security. These are fixed income securities that can be bought or sold in an organized financial market. Okay? They are financial instruments or they are debt instruments. They are debt instruments. Instruments that are tradable. Or traded in the market. So you can go to the market to buy. Okay, I said examples include. So you can go to markets to buy your bonds. It's tradable. Examples include bonds, debenture, and then loan notes. All right. And one of the characteristics of bonds is liquidity. So bonds, the traded debts are usually liquid. All right, they are tradable. You can easily sell it when the need arises. For example, if you invest 100 million naira in a bond, and then a year or few months down the line, you need money for some other things, so you can dispose of your bond so that you can get your money back. So it is it's liquid. All right, that's what we mean by liquidity. Yes, Oluwatosin, talk to me.
Yes, good evening, sir.
Yeah, good evening.
Yeah, please, we mentioned the callable, non-callable, redeemable, non-redeemable. Now we talk about the trade and non-traded. So I just want to confirm, if this is the time, the non-callable, callable, those ones, are they category or what do we call that? Just for knowledge sake.
When you talk about the types, the callable, the traded and non-traded, this is the high-level categorization of the debt. So when you now talk about redeemable or irredeemable, those are the subcategorization. Okay, those are the categorization. So when you are referring to redeemable debt, for example, what you are referring to are simply bonds, debenture, loan notes. Okay, but at the high level, you call it traded and then non-traded. Do you get? So it's still the same thing we are talking about, but just like when you say traded and non-traded, let's say it's a kind of a summary types of the bond. All right. So like I mentioned now, I said traded debt, and then examples include bond, debenture, loan note. So when you are talking about redeemable, what we are referring to are bonds, debenture, loan notes. So it's just do we say nomenclature, or depends on the perspective you are looking at it. Okay then. Yes. Tosin, hope you got that. Is it Tosin or Tony?
Yes, sir.
All right then. All right. So yeah. So for the non-traded debts, the non-traded debt are fixed income securities that are not tradable or that cannot be bought or sold in an organized financial market. Yes, who can give us one example of non-traded debts? At least I've given you examples of traded. So who can give us an example of non-traded debts?
Bank loan.
Yes, bank loan. Yeah. Sonia, you want to give me one more?
Overdraft.
You are correct. You are correct. Yeah, pàtẹ́wọ́ fún Sonia. Clap for Sonia. Pa, 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 pa. Well done. You guys are ready for ICAN. Hey, before end of July, ICAN is going to release the exam dates and the exam fee. From that moment on, I'll begin to sing to your hearing anytime we meet about the judgment day. But I know for sure you guys are ready because I can see some of you are really hot on the SFM on the WhatsApp group. You guys are really hot, bombarding your lecturers with different kinds of questions. If the upload is not done within a minute, now voila. No worries, no worries. Be rest assured you are going to qualify this year by the grace of God. Just do your best, all right? Just do your best. Be committed. Show more determination that you want to achieve that excellence, this diet. Tell yourself that you are going to qualify and you will achieve it. It's just a matter of time. Within the next few months, you will receive the news, and then the Xmas will be a double joy for you because your exam will be released between on the 20th to 23rd, between 20th and 23rd of December. Aha, few days to the Christmas. All right. So when you are eating your Christmas chicken, you remember, and when you pass, God, I thank you. You invite you invite your friends and colleagues to your home to come and marry with you, to celebrate your qualification. So shall it be. It will be a double joy, don't worry. But right now, you have to do the work. You have to do the grand work by studying hard. Every day matters. Okay, every day matters. 2 hours minimum per day is very important. It's very important so that you can achieve excellence on that day, so that when your result is being released, you are going to have a beneficial outcome. All right. Don't worry. You will surely achieve it by the grace of God. Okay. So these are securities that are not traded, that are not traded, or that cannot be bought or sold in an organized financial market. So examples include bank loan and overdraft. Of course, can you take your bank loan to the market and sell? It's not possible. All right. You can't take your bank loan to the market to say because you need money, you go and sell the loan, or your overdraft facilities, you take it to the market to go and buy it. That's not possible. So they are not tradable. These are securities that are not traded. Okay. All right. So that's that about traded and then non-traded debts. All right. So the next area we are going to discuss, should I even give you the market value, how to estimate market value of fixed income securities, or I should wait till when we get to weighted average cost of capital? Let me see. Okay, let me just give you the market value. Let's do it this way. let me start with debts. Let me start with this guy here. Market value. Move to the next slide. Market value of debts. So in case this is very common, you can even see this in valuation. Okay, you can see this in business valuation. Examiner can ask you to determine or to calculate or estimate the market value of debt instrument or financial instruments. You need to know what to do. Okay, you need to know what to do. It's very simple and straightforward. Also, you are going to do bond valuation. For example, Mr. Ashwaju will take you bond valuation and analysis. So he will also demonstrate more how to determine, how to calculate the market value of bonds, for example. Okay, so what do you mean by market value of debt? Okay, I told you the other time that debts are tradable. We have traded and non-traded debts. So these traded debts, it simply means that you can buy it, you can also sell it in the market. So that means there is an interaction of demand and supply. Therefore, how do you then determine the market value of the debt? So that's what we want to discuss. So the market value of debt represent the present value of future cash flows. All right, represent the present value of future cash flows discounted at the yield or rate of return of the debt. Okay, so let me put it down for you. There are two different ways depending on the nature of the debt. So I'm going to divide it into two. All right, so the market value of, okay, should I put it? Let me separate it, but let me do the one of redeemable here. The market value of redeemable debts represents the present value of future cash flows. What are the cash flows? There are two cash flows, two different cash flows. Okay. That is, the first one is fixed interest, and the second one is principal repayments. Those are the two cash flows attached to redeemable debts. So anytime you want to calculate the market value of redeemable debts, simply go ahead and calculate the present value of interest and the principal discounted at the yield or rate of return on the debts. All right, so that's that. So how do you then calculate the market value of redeemable debts? The market value of redeemable debts can be calculated using the table below. So for those of you that did not jump fence, right? You have calculated net present value before during your skills level exam and all of that. So you have calculated NPV before. So the same format we normally use to calculate NPV is what you are going to use. I can use formula, I can also use table. All right. So whichever one, you are going to arrive at the same answer. All right. So that is market value of debts. So this is the format. Sorry, let me increase this. this is the format to calculate the market value. Okay, so the first column will be the year. The second column will be description of items. The third column will be for cash flow. The fourth column will be for discount factor, where you are going to use the yield. Factor. Then the last column will be the present value you want to calculate. Okay, so this is the format for calculating the market value. Of course, this will be in Naira. This will be in Naira. So, like I told you from this definition of market value, I said that the market value of redeemable debts represents the present value of future cash flows. What are the future cash flows? Interest and then the principal repayment discounted at the yield or rate of return on the debt. Usually, if examiner wants you to calculate redeemable debt, you are going to be given the yield. The yield is the internal rate of return. You can call it internal rate of return or yield or rate of return. Simply put, rate of return is the same thing. All right. So for redeemable debt, for example, there are basically two cash flows. The first one is fixed interest. Remember, I told you that redeemable debt is the one in which the company will pay annual fixed interest and the principal at the maturity date. So you are supposed to, anytime you want to calculate the market value of debts, of redeemable debts, first thing first, you need to calculate the present value of the fixed interest. Then step 2, you calculate the present value of the redemption value. Okay. Then you had the two together. Whatever you have, then represent the market value of the redeemable debt. It's not more than that. So don't let examiner scare you. All right. Don't be scared. Anytime you're asked to calculate market value of fixed income or of debt instruments, so you should know what to do. Okay. This is the total present value, or just say market value, or you call it present value, is the same thing. Whether you call it present value or market value is the same. It's not more than that. So watch out. Now, what are you supposed to do? You can see this one does not have year zero. If you put year zero, that means you are calculating NPV, right? Because what your intention is to get the present value. That present value is the market value. Therefore, to do this, you go to the question, right? You go to the question and pick the fixed interest as given to you. This interest, the number of years you are going to put here will depend on the maturity date. Let's say, for example, the maturity date of the redeemable debt is 5 years. It means that the company will pay annual fixed interest for the next 5 years. Therefore, because the interest is constant, all right? So because the interest is constant, so I'm going to calculate annuity factor. I will calculate annuity factor of year 1 to 5 using the yield. The yield will surely be given to you. Yield is the percentage. It will be given to you in the question if you are to calculate the market value. So you then use that yield to calculate your annuity factor of year 1 to 5. Whatever it is, you put your annuity factor here. Then the interest as given to you, go to the question, you confirm if you are given tax rates. If you are given company tax rates, then you must adjust for tax when you are calculating the market value. Okay, because remember what we said, there will be tax benefits. So you come here, whatever it is, you put your interest there. Then the interest multiplied by the annuity factor, then you multiply the two together, you get the present value. You then go back to the question and check these redeemable debts. Okay, it's going to be redeemed in 5 years' time. How am I going to redeem it? Is it at par, at premium, or at a discount? Whatever it is, the information will be there in the question. So we're assuming that it will be redeemed at par. So we put it there. Okay? So that is what you need to do. Again, you go ahead and calculate discount factor for year 5 using the yield. Put it there. Multiply the cash flow, redemption value, and then the discount factor at year 5 or whatever the maturity. Multiply the two together, you get the present value. You then add the two of them to get the market value. That's why we said that market value of redeemable debt represent the present value of future cash flows discounted at the yield or rate of return on the security on the debt. So that is basically what how to calculate market value of redeemable debt. That is no more than this. I can also use formula. I will still get the same thing, but possibly when we do calculation, I can demonstrate the two together. But for now, note this. Yes, somebody is sending me a message. Let me check. Oh, okay. Olakeni, are you laughing or you are crying? What happened? Kende?
I was only laughing when you
Kende?
were talking about Christmas, having the result before
Oh,
Christmas.
okay. That's all right. Okay, then. So let me just let's go back to irredeemable debt, because the way you calculate market value of irredeemable debt is different from redeemable debt. So let me just come here. Let me come here. Oh, let me match the two together in the same place. Yeah. Let me match the two together. So let me start with the other one. So the market value, let me just write it down because of time so that I don't extend beyond 11. A student sent me charts yesterday. She has a concern that I should please the class should always end by 10 o'clock or 10:15. And I said that that would be very difficult because of the fact that we have a syllabus to cover. So 1.5 hours will not be sufficient for each lecture, because she told me that I should also inform all the lecturers that they should stop class by 10:15 or 10 o'clock. So and I said that will not be possible because we have to cover the syllabus, and 1.5 hours will not be sufficient for us to be able to do justice to the syllabus. All right, I understand her concern. Possibly she's one of those. She said, according to her, when she gets home, she's already tired for the day, and then waiting till 11 o'clock is always challenging for her, you know. So, but it's what it is. But thank God the classes are recorded. So at your convenience, you can always go back to it and watch. It's what it is. It's what it is. All right. So the market value of irredeemable debts is the present value of future interest discounted at the yield or rate of return on the debt. Okay, so this is the market value of irredeemable debt. So here is talking about present value of future interest. The only cash flow, remember, you recall earlier today I mentioned to you that irredeemable debt is the one in which the company will pay annual fixed interest, but the principal will not be repaid. So the only cash flow associated with irredeemable debt is the interest. It is only the interest that is associated with irredeemable debt. So anytime you want to compute the market value of irredeemable debt, it has to be the present value. Sorry. Let me quickly complete the class so that we can close the. Sorry about that. Okay. Let me see if I'm still recording. Yeah. So let me quickly complete this. I was saying that the market value of irredeemable debts, let me highlight this. The market value of irredeemable debts is the present value of future interest discounted at the yield or rate of return on the debts. Okay, so that is how to calculate the present value. Anytime you want to value fixed, you want to value irredeemable debts, that's what you need to do. It is calculated as the ratio. It is calculated as the ratio of fixed interest to the yield or rate of return on the debt. Okay. Depending on whether or not there is tax. So depending on whether or not there is tax, using the formula below. So the same formula that we normally use to calculate cost of irredeemable debts is what we are going to use. We just change the denominator to make it a subject. All right. So the same formula we have here. So it's what we are going to, anytime you want to calculate the market value, market value, that's what you are going to do. So, for example, here we are assuming that there is no tax. So you can see this is the cost of, this is how to calculate, this is the formula for calculating cost of debt. All right, which is the ratio of fixed interest to X interest price. This X interest price is the market value that you want to calculate. Therefore, you want to make X interest price the subject of the formula. All right. In this case, I will just come here to say market value of the irredeemable debts where there is no tax. So this one will then become KD, the cost of debts, or you call it rate of return, R. Okay. So of course, there's no percentage here. That's it. This is the formula for calculating cost of irredeemable debt where there is no tax, where R equal to rate of return. All right. Or the yield, you call it rate of return or yield. All right. So that's that. Where there is tax, do the same thing. Change this one to the market value of the debts. Then this denominator, this S int price, should be changed to the yield or cost of the debts. So which is rate of return. So that's it. This is how to calculate market value of irredeemable debts. So that's basically that. I've already shown you how to calculate the market value of redeemable debts. Let me highlight it. And also the future cash flow here are the interest and the principal repayment. These are the key points you need to take into consideration. All right. So before we leave, let me show you. Let's just talk about the market value of, let me copy this. The market value of preference share. That's where we are going to stop. Where is preference share again? Yeah. Let me just do it. Market value. Market value of preference shares. Okay. So the market value of irredeemable preference share. Irredeemable preference shares is the present value of future dividend. We don't have time, so I just have to write so that we can close the class. Discounted at the yield or rate of return on the preference share. Okay, on the preference share. It is calculated as the ratio of fixed dividend. You can see it's not difficult. They are similar. You can see I'm just copying the same information we have done before. So ratio of fixed dividend to the yield or rate of return on the preference share. Preference shares. Okay. That's it. This one does not have anything with us. Using the formula below. All right. So how did we calculate? Let's go back. How did we calculate the cost of irredeemable preference share? Remember, this is the formula we used. It's the same thing we are going to do. Just change the denominator to subjects of the formula. That's all. You can see it's not difficult. That's what I told you, that you just have to, this is market value. You just have to understand the concepts. You understand the concept that you can express it the way you want on your own. Or you say R. R is the rate of return. Where R is equal to yield or rate of return. So it's as simple as that. Rates. All right. Now, the second one, which is redeemable, market value of redeemable debts. Let me just copy this one here. Yeah. So again, the market value of redeemable preference share represents the present value of future dividend and principal repayments discounted at the yield. All right, market value of redeemable preference share. Preference shares. Preference. Okay, represent the present value of future cash flow, that is fixed dividend and principal repayment discounted at the yield or rate of return on the preference share. See, it's not difficult. It is calculated. Okay. It can be calculated using the formula below. All right. So to get the market value, okay, to get the market value of redeemable debts, simply go ahead and calculate the present value as we did for redeemable debts. Okay, using the same format here. It's the same thing. So where are you? Yeah, can be calculated. Oh, it can be calculated. I repeated it. Okay, so that's it. So instead of fixed interest, it will be fixed dividend. So what we are just changing dividend for interest or interest for dividend. It's still the same format. Nothing has changed. All right. So basically, this is how to estimate market value of preference share and also market value of debt. And this is where we are going to call it a day. Let me know if you have any question for me. Let me check. Beatrice is saying that, Promise is saying that, I'm also surprised just as you. What's that? So let's close before you start doing YY. It's okay. All right then. So let me know if you have any question for me before your high side doing YY. Oh yeah, now any question for me so that we can close the class. So in our next class, by the grace of God, we are going to start with cost of convertible securities. We then move to discussing weighted average cost of capital. Then from that moment on, we are going to begin calculations. So once we are done with all relevant calculations under work, we then move to project-specific work. Of course, we can't do project-specific in our next class. All right. Worst case, possibly we'll be able to do one or two. We should be able to do like 2 illustrations. Then in the after next week, we also do another illustration under work before we then move to project-specific. Then Wakuka. All right. So that's that. Let me know if you have any question for me. If not, then we close the class. Let me check those of you that are still online. Yes, I can see. Abigail is still keeping me company. Abiodun is here with me. God's power. Then Raphael and Shakira. Then I have Dekunle. I have Faith with me. I have 2 Faiths. Ekosi Faith, and I also have a Faith Accommodate. I have Fortune. I have Gbemisola. I have Glory. Hey, I'm a glorious child to my parents. You can see different kinds of beautiful names. Fortune, Faith, Gbemisola. Carry me to wet. That's the meaning of Gbemisola. Carry me to wet. Glory, Ibrahim, Mohammed, Idris. Right? I can see. I can see Ife. Jeremiah is still on. Matthew is here with me. Right? I can see Olakeni. I can see Olaide Simbiat. I can see Oluwabukola Akindoyin. Yeah. I can also see Oluwatosin Akinsheye. I can see Oluwayemi Folusho. Promise is also here with me, keeping me company. Right? I can see Rabias, Diriso. I can see Sonia. Temitope Ademuyewa is also here with me. Okay. I can see Toluwani Olumodeji. Did I pronounce that correctly? My bad.
Yes, sir. Yes.
Thank you very much. Then I can see Victoria Adejo, then Yetunde, Yetunde. Thank you, every one of you, for joining the class. Please, I beg of you, your notes are started piling up. We started accumulating your notes. So please don't keep your notes without studying them. All right? Keep up with the energy. The way you are showing energy in the group. Oh, where is the video? Where is the material? You must ensure that you study, right? Study. Don't just study. Study well. Ensure that all what you have been taught on each lecture day, you understand them. Then put them into practice, all right? Put them into practice so that you can retain it, all right? God will make it easy for you. So by the grace of God, when next we are meeting next week Tuesday, we continue from where we stopped today. Thank you, everyone, and then good night. Okay.
Good night, sir.
Thank you, sir.
Yeah.
Good night.
Thank you, sir.
Good night.
Good night, sir.
All right. Take care.
Good night, sir.
Good night.